Howdy, everybody. This is Thomas Talbert with Prime Properties here on the Leasing Austin podcast. I try to bring in investors or anyone who's interested in buying and selling or renting real estate here in Austin, Texas. And I have brought along Mr. Ryan Kelly for the very first episode, I guess I'll call it. How you doing, Ryan?
I'm doing great today. Glad to be the premier guest. I love it.
Yes, the premier guest is exactly right, and guinea pig. And thank you again for coming along on this very first try. Well, Ryan, can you please tell me a little bit about yourself and your background?
Sure. Ryan Kelly. I am a real estate broker and now a mortgage lender as well. I'm with Keller Williams Realty, been with them over 10 years here in Austin. Been in Austin for about 33 years now. Came here to UT after growing up in Waco, and spent my first career, which was about 20 years, in the broadcast and PR industry. And so actually worked in local TV news in Waco and Austin, and then worked in PR. And then, like most people, decided I didn't want to be W-2 for someone else the rest of my life, and started exploring career options in my kind of right after I turned 40. And I was, in fact, you and I share some similarities. We both were members of the Young Men's Business League here in Austin and had a lot of good connections through them. And I really thought I was going to be a certified financial planner. So I was really interested in investing and growing wealth. And all I knew really on a high level was the stock market. And so spent a lot of energy in that. I was actually taking classes at UT to get my CFP and go that direction. But at the same time, just something wasn't clicking. I was having lunch with the guys that were in the industry, and it just didn't sound that exciting. And so I was like, okay, I like the topic. I like building wealth. I like the energy. I want to work with those types of clients, but there's got to be some other angle here. And ultimately, what really clicked it for me was I was visiting with my father-in-law. My wife's parents own multiple doors in College Station. In fact, at the time, they were pushing almost 30 doors in College Station. I was like, wow, okay, so landlords, huh? Like, what's that about? Do you like it? I've always heard negative stories about landlords. How much money are you making? So I was like kind of pestering them a little bit about, how's that working out? But at the end of the day, they were basically living in retirement off their rental properties, making six figures net. And I was like, okay, wait a second. You're making really good, we'll call it income off these rental properties, but you don't have to sell them. In the stock market, you have to sell them, right? You build this big pile of stocks, you get to a date, and then you start selling them right back off to get the cash back out, unless you have so much money you're living on dividends. So anyways, I did the math on that and said, okay, I need to talk to some real estate people, because that really hadn't crossed my plate on any high level. Once I started going to lunch with some realtor friends, they're going to be very candid with you too. You and I know it's not an easy business. It's eat what you kill. It's, kill or be killed kind of business. But at the same time, I could immediately do it the way I wanted to. I didn't have to go work in a strip mall for Edward Jones and work my way up and get all these licenses and beg to get a good desk at a high-end firm. I could just go do my business day one. And then on top of that, the fact that I learned about real estate investing, it was almost, I don't want to say overnight, but very quickly, a few weeks, pivoted within a month, got my real estate license. Within 2 months, I was on the ground, burned all the bridges, no more corporate world, and I was full-time real estate.
Well, that's a fantastic story, and interesting that you dove into it here at age 40. So many people, I feel like, turn to real estate, like you said, of, I want 100% of control of my future here. Like, there's this W-2 job is not as secure as I may make it out to be. Now, how is having that control and being able to, everyone in their head is like, oh, that means total freedom. It's like, no, you have to work. But it's 100, you're working 100% of your time is being focused on you, not your side hustle isn't working on you. So tell us a little bit about like working for yourself and how you've had to really structure your days to make sure that you're getting every single moment out of your day to get the best result out of building your own portfolio.
That's great. And I would say, you and I know this too, the failure rate in our industry is like 80%. So in other words, within 3 to 4 years, 80% of people that get their license are not in the business anymore. But I think the main reason, it's not mindset, although mindset is really important. I think it's structure. And I think if you come from the W-2 world, 90% of the business wasn't done by you. It was done by HR and the CEO and the rest of the company. You only had to do your little piece. You didn't have to worry about what other parts had to keep that business going. When you go into real estate for yourself, you have to do all of it. You are HR, you are sales, you are the accountant, you are everything. And so what happens is if you don't learn those skills or you don't wear the hat of an entrepreneur, at least learn them enough so that you can then, give them to someone else once you decide it's not the skill you want to do. I think that's the number one thing I see people fail. So when I dove in, I said, I'm burning all the bridges. There is no turning back. I am going to learn this business and I'm going to run it like a business. So, I was on QuickBooks when I made $2. So I didn't wait until I figured it out to then start adding the tools. I figured I'm going to start with a CRM day one. I'm going to start with QuickBooks day one, and I'm going to figure this business out. And then number two, I would just really try to level up who I was networking with so that you're asking the people that are having success in the business. They're several years ahead of you in terms of just skill set and experience. What are you doing? That's it. What are you doing? What software do you use? How are you spending your day? What does your calendar look like? And so I'm by no means perfect. And there's lots of things I know I should be doing that I probably still don't do. But at the end of the day, if you model yourself after people that kind of survived that initial kind of test run in the business and they're actually making it work, to me, that's the number one advice I would give a younger person is like model yourself after the people who have clearly survived and thrived in the business.
Mm-hmm. No, that's a fantastic. I always tell people like I am the least creative person of all time. I just copy what other people do. That's exactly
the best part of our business.
Well, Ryan, it really is. Like there's someone has done it before us.
I'm not the first person who have printed a yard sign, right? It's like I have a yard sign, you have a yard sign. Like there's things we can do in this business. There's creativity, of course, but the blueprint for success has already been developed. It's just how much are you willing to follow it? And that's really what it comes down to.
It really does. Ryan, I want to pivot a little bit to learn a little bit more about your real estate portfolio. I understand you recently just closed a deal or under contract or something like that.
Got 1 week to go.
Sorry.
So we are in the middle of the deal.
Just because you're under contract does not mean it's done.
It's not done.
So
it's looking good.
Can you tell us a little about your portfolio and of course like your general acquisition thesis here in the Austin area?
Yeah, the first investment we made in real estate, not including a primary, was we bought our first house in 2008. And I can tell that story. But since we're going to focus on investing, our first investment was in 2018. And I was at a listing appointment. These were some parents of a church friend of ours. And he said, hey, my parents have owned this house a long time in South Austin. It's going to need some work, but they'd love to talk to you about potentially listing the house. So I met with them and it needed work. It had rose colored carpet and linoleum floors and some foundation trouble and wood paneling and all the things you can imagine in a fix and flip kind of house. And it was a very small little house. It was like 1,100 square feet. And I was not planning on buying it. I left there and you're driving home and I'm thinking through my head, okay, who am I going to be selling this house to? It's probably going to be flippers or investors. And I'm thinking through how I would kind of market it to them. But then I was like, wait a second. Well, why don't I buy it? Because I'm looking to invest in something. We hadn't bought anything yet. And I said, why don't we buy it? So anyway, so I talked to my wife and kind of told her about the house. And I knew what we could sell it for, or at least roughly what it would market for. And so I said, hey, if I can, take the commissions out and I can do all these things, maybe I can give them a lower price, pull the house off. So we ended up buying the house. How did we finance the house? I financed it with $5,000 out of my own pocket. This house we bought for $255,000. I spent $5,000. So where did the $250,000 came from? This is where good family is worth your weight in gold. So I spoke to my in-laws first and I put my little pro forma together and I said, here's what we're going to try to do. We want to fix this house up. I think if we can fix it up, rates were good back then. I can refinance this house. It'll be at a higher price and then I can pay you guys off. So I said, we need to borrow $250,000. I don't want to go to the bank. I want to see if we can get like private notes, essentially. And so they said, okay, we'll do it, but we only want to do half. Oh man. All right. I got to go get the other half. Oh, hey, let me call my mom. So I go, hey mom, they're going to do it. Would you match their note? So essentially we had 2 private notes of equal size, and we wrote them checks every month and paid our notes until we were able to refinance the house. So we spent 75. The reason is because we needed to save money to do the work. Right. So we spent our own cash to fix the house up. We thought it originally was going to be 35,000. I think we spent over 70. Sound familiar? So everybody that wants to fix a house thinks it's cheap, and then you do it and you go, oh, I forgot. I got to pay for that, that, and that. So we fixed the house up, but we paid off their notes with a refinance. So at the time we had a $250,000 set of notes. We ended up refining at $300,000 because the house appraised higher. And so we took a cash out refi. This was 2 years later. We took a cash out refi. We got 50 grand back. So the note that's on there now, we still own that house. Note that's on there now is paying down. But we used that 50,000 to buy another single family house. So that house became 2 houses, and we started with $5,000.
That's incredible. And just an infinite return on investment. If it's $5,000, that's incredible.
I'll include the 70 that we had to spend to fix it up. So let's say we were all in at 70,000, but once we did the cash out refi, we're now in it for about 25,000. And it's probably worth 400,000 today, we think. So give or take market value, it's probably right around 400,000.
No, that's incredible. And what's the size of your portfolio at this time?
We're at 6, but we're about to be 8. So we're under contract on a new construction duplex. I like Bell County a lot. So for those not familiar, these are markets like Killeen, Temple, Belton. So we're in Temple. I've got 3 properties up there if you include this new one. And so I can tell you that story too. But basically we're working with a builder who wants to close a few sales before the end of the year and are starting to work some pretty nice deals.
We're seeing a lot of that in the new build community of these builders that are trying to get rid of their inventory, and they're trying and they're cutting some real deals. And that's what we're telling a lot of our clients and investors to look right now is like, hey, these are the guys that are going, the nice thing about those new builds is that there's no maintenance. They just
brand new,
and there's no maintenance for 5 years. You can probably bank on there nothing being broken, and they usually give you a builder's warranty for like the first year or something like that, and they probably give you a good interest rate, which right now is the name of the game if you can get a good interest rate right now.
And I would say, adding on to that, you really got to know your strategy. So for me, the duplex that we're under contract on, I may never sell. Like, this is a hold forever. If I sell it, it won't be at least for 10 plus years. And so, because you need to give new build areas a lot of time, because the upside of a new build, like you just said, is it's perfect and it's new and nothing needs to be fixed. The downside that though, is you're in an area where all the builders are hanging out and they're going to be still building for the next 5 or 10 years, at least until they finish out, maybe that zip code or that area. And so if you go to sell it in 2 or 3 years, which is a big problem we're seeing in Austin right now, you're still competing with the model home in your community. And so the builder can incentivize all their new builds with low interest rates or closing cost credits or appliance packages or whatever. You can't. Your house is 3 years old and your buyer would have to pay full meal deal. And so what happens is you're kind of stuck. And so what I tell clients on the new build side is, if you are a long-term hold, this is not a 3 to 5 year plan. This is a 10 plus year plan. Absolutely go for it. If you're looking at something that, hey, if your strategy doesn't work out and you want to offload this thing, then you need to go where the inventory is tighter, and you need to go where value add. So think little older neighborhoods, maybe no HOA neighborhoods. You need to get into neighborhoods where you can value add your way out of it. Like you can improve the property and change the price, because you are not going to be able to do that in a new build neighborhood.
No, not at all. And even in the rental side of it, which we get to deal with a bunch, is the builders are now starting to rent the homes out, the ones that they can't lease. We're starting to see that now. This is probably the last 60 days, and we're seeing that. And that the builder we're still competing with market price. I mean, like they can't offer the same things that they can offer if they're selling.
Right.
But in these new communities that, like you said, would you, Mr. or Miss Tenant, potential tenant, would you like to live in a house that has literally never been lived in?
Yep.
Or the 3-year-old model, like you said, it's really hard to compete with that. Because
Very
even
hard.
if the other model's perfect, there's maybe a stain on the rug, the painting's not perfect, but we're seeing a lot of that right now, and that's affecting, certainly in Bastrop specifically is where we're seeing a lot of that happen, in South Austin, east of 35.
Yeah, I was
where
going
we're
to say
seeing a
east
lot
of
of that.
35. That's where a lot of the new construction is. We're seeing stuff out in Manor and Hutto. So just those east side band communities where lots of new builds are going on, and that's where all the land is. And so even when the market picks back up, and it will, guess where they're going to build more stuff? They're going to build more stuff in all those communities because that's where the land is. And so what's going to happen is you look at Pflugerville, call it 15 years ago, maybe 20, that was kind of the Hutto of the time. Maybe East Round Rock, parts of those areas. Well, now it just keeps shifting east. So now your big new build areas are Hutto, East Georgetown, Taylor, Manor, Southeast Austin, and then give it another 10 years. Where's it going next? And so if you're buying in new build areas, I say you're in it to hold it and sit there, because it's going to take a minute for these areas to start appreciating again, for the inventory to tighten up and get kind of back in balance, for rents to go up. And so the upside of that, though, is why you're able to get the prices that you're getting now, because it's harder for them to sell. So you have to decide, do you want the rents, which you're going to have to wait for because they're kind of going down right now, or do you want the price? And so I look at it that way. I'd much rather get the price, because everything else is an adjustable number over time. Your costs, your rents, vacancy, things like that. That's what you're going to manage over time, but you can never buy it again. You only get one shot at that. So I'm much more focused on price.
Now you marry your principal, you date the interest. That's
That's
what
right.
I was always taught. And it's funny you mentioned these building communities and restricting the inventory to other parts of Austin. I'm looking at the map behind you right here. Everything on that 130 corridor out east, the dirt is really soft. It's really easy for builders to dig up a foundation real quick and put it in. The construction costs are really low.
Yep.
And that's why you're able to build, and it's flat. You're just able to build for as long as you can go. And then if you're looking at the west side of Austin, which is, again, a great visual that I get to have right over your shoulder right here, there is a river system that locks up certain parts of the land. You can't just jump right across the river and start building again.
Nope.
I mean, it's an hour and a half on the other side of that. And then also the dirt starts to get it really, really rocky. And
hilly.
It becomes
very hilly.
Very hilly. And when you're trying to pour foundation on limestone, I mean, you got to straight up use dynamite in some instances to get the foundation where you want it to be. And even, let's assume you don't go into the foundation, dig down for your foundation. Framing a foundation is twice as expensive, just because you have to put up all of that concrete above ground and fighting with all that concrete to actually get it to do what you want it to do. All those houses have foundation issues if it's built on top of limestone, because it just, it's just tough. And I thought that was a really good point, because you're right. Because like the pricing, if you were to look at a map of Austin and we were to look at like average pricing west, because of that fact that it's so much harder to build over there, there's no really new communities unless you're going out towards Dripping Springs.
And those are high end. Those are expensive communities. Same with Leander on the west side. If you're in the Crystal Falls or the Trevisos or the, kind of higher end neighborhoods over there, they're usually on the west side because people want a view, and that's what you get with the hills. And also it's harder to construct because you have to build big foundations to sit on top of these hills. And so, I call it the luxury side of town. None of my investors are buying over there. Maybe a West Coast Californian would swing in and buy a $2 million house, but the average person is looking for the discounted, maybe below median priced property that would make a good rental to like a B-class tenant. That's essentially the target for most investors, is you want something good, but you want to get it at a fair, maybe below market price. And so that's going to tend to push you into older neighborhoods and east, or, northeast, southeast kind of direction, because that's where you're going to see the prices get better.
Absolutely. And speaking of finding the deals, I have put it upon myself for my clients recently to try to be the person who's finding them those deals, because you're honestly, a good cash flowing deal, you're not going to find it on the MLS. It's just not going to happen.
Yeah.
And it would be really hard, and they fly off the shelf like that because they're a good deal. And so I've been trying to network with wholesalers recently to, those are the people, and I'm busy running my management company. I can't go out and find those deals on my own time. The wholesalers really what I'm turning. Is there a specific, how are you finding those deals that investors or yourself are potentially looking to buy?
I think you have to make a deal too. And to that point, just to give you a perfect example. So the property that my wife and I are buying theoretically was on the MLS, but it was listed at 380, maybe 385. We're under contract at 329. Did we negotiate that? No. What happened is the builder dropped their price on a different unit for one day down to 329, with the caveat that somebody needs to close before the end of the year. And it wasn't me buying it. I actually have a client, and we both kind of saw it at the same time. We're like, let me call the builder rep and see what's going on. And so this was one that was on the MLS. So anyways, the numbers worked. We underwrote it, everything worked. And so he just had to act super fast because the builder had such a tight timeline to close. So anyways, we get that deal under contract. All the other inventory they have is listed at 380 to 405. Okay. But if you make a phone call and go, hey, would your builder do that again? Right? Hey, if you can do that deal, how about one more? You want to close one more before the end of the year, same timeline, same terms. It's not listed on the MLS. Okay. She makes a phone call, runs it up the ladder, and ta-da, we were able to get one for ourselves at the same deal. It's not listed. Yeah, theoretically it's on the MLS, but it's not on the MLS at the good terms. It's on the MLS at the regular terms. And so sometimes you just have to talk to people too. And I'd say the same thing for the stuff that's on the MLS with regular sellers. Some sellers are stuck. They've got debt. They bought it 3 years ago. They just can't lower the price. And we've negotiated with many of those sellers this year. And even though they get it that you need to buy it at a lower price, they can't do it because they'd be underwater. Other sellers have plenty of equity. And once you have a negotiation with them, you're able to get houses at lower prices than they're listed. And all of a sudden the numbers work better. Single family is very challenging. But, I have plenty of investors that are willing to put the capital down because, again, they like the price. They know all the other metrics are tricky, but their thinking is that when Austin rebounds and it gets healthier and the market gets to a better place to sell, that house has gone up in value, but so have all the metrics, your rents and maybe the interest rate you can adjust one time, things like that. Just like you, I also follow wholesalers because I really want to see what they think their deals look like. Sometimes they're deals, sometimes they're not, but they're doing the most volume off market. And so it's really good to keep up with the wholesalers. And then also with the new communities, they're not really listing all that stuff on the MLS either. They may have a couple of their properties there just so you can search them in the MLS, but in reality, their full list of inventory, you have to go to them and get it. And so keeping in touch with the builder reps, knowing what your clients are looking for and where they're looking is where you have to spend time on relationships. And I would say that's another, especially with new builds, it's relationship driven. You've got to call them and get in touch with them and kind of understand what is their goal this month. Are they trying to sell an extra one? How are they trying to pivot their incentives? Because really they can do things regular people can't with the incentives. And so you're trying to figure out how are they using the incentives to maximize their properties getting sold? And does that align with what your client wants? And so that's a lot of what we're doing to find those deals. We do get, I'll call them pocket listings and things like that in the office as well, but they're very random, if that makes sense. It's like, you just don't know what you're going to get with those. So sometimes it works. But a lot of times, if you already know what your client wants, you got to go where that flow of deal is coming through, which is either going to be, we need to go find something discounted on the MLS, we need to get it from a wholesaler, or we need to have relationships with builders. And that's really the three channels that have worked the best this year.
No, and I completely agree with you. And on the points of, I had not really considered how well the builders can manipulate out of the price, the interest rate. You're 100% right. There's a lot more that they can negotiate on that normal sellers can't at the moment. Speaking of that, we're getting a lot of those people that you mentioned earlier that are, they bought in 2022, they've got a big interest rate and they have to move for a job or somewhere else, but they're underwater on their home. It's so tough to help those clients in that situation, because even in terms of rent rates right now, I'm not able to save them a lot of the time of like, oh, don't worry, we can lease it out and completely cover your mortgage payment, and you can not be coming out of pocket every month. And
that's right.
People just assume people who own houses have deep pockets to be able to do that. No, they can't. They cannot.
No, doesn't always work that way.
How have you been navigating those conversations? And I imagine you've been having with plenty of buyers or really sellers right now in this market.
We've been having them for 3+ years now. In fact, Austin's now in year 4 of a correction. And I'm not a property manager like you, but I will do lease listings for clients. And I typically do at least a dozen or so a year of lease listings. And I'd say more and more, it's those types of clients that are like, I'm kind of in a pickle. And so what I tell clients is this: let's say your mortgage payment is $2,000, and that's your mortgage, taxes, and insurance. And for many of them, it's higher, but let's just stick with 2,000. And let's say you can only get $1,700 a month. Rents have gone down. Maybe in peak COVID, that was $2,200. Now it's declined, and maybe the rents are at like $1,700. So a typical person is going to go, I'm negative, I'm underwater, I'm losing money. My argument is, you're not losing money. You're actually just investing more money into the property. Remember when you made your 10% down payment? Now you're just adding to that every month. That's what you're doing. The tenant's paying 90%. You're paying another little 10% every month as additional capital into your property. Essentially what you're doing is buying time. Everybody hears that phrase. They hate hearing it, but it's exactly what you're doing. You are buying time, because it's going to take, in my estimation, and this is based on my gut instinct with the numbers, it took us 3.5 years to get here. It's going to take us 3.5 to get out. So let's say the market starts correcting in 26, which it may, and it may go sideways, and maybe the inventory stops building up and kind of starts going sideways, and some of the people that have been stuck in their homes can start to sell again. Let's say all that's true. Okay, well, add 3.5 years. We're probably at 2029, maybe even 2030 before we're really back to like full appreciating, healthy. Sellers have a little more power again. Rents are going up nicely and noticeably. Like, it's going to take a minute. And so I have that conversation with sellers to go, are you comfortable buying that amount of time? Because if you can buy that amount of time, you're fine. You haven't lost a penny. You're just reinvesting into your own property. Tenants will help you out while you're waiting for your property to get back to some level that makes you feel good, and you can sell your property. But if you're not comfortable doing that, then you've got a very difficult decision to make. And it's, are you willing to take the loss? And we'll calculate it and go, here, you might lose 40 grand. You might have to write a check at closing for $40,000 to bring to the title company so that they can pay off your mortgage. And you just go, because that's the reality. That's the truth. And the other option is you call the bank and work out a short sale, which probably isn't as much fun as writing a $40,000 check. So you just have to have very candid conversations. But I like to put it in the frame of mind that you're not losing money. You're investing more money. You thought you only had to spend this much, and now you've got to spend this much to invest in that property. So you're recapitalizing that property when you're covering that difference between your payment and the tenant's income.
That's a much better way to phrase it. I've been, admittedly, I've been bad at phrasing it recently. It's like, do you want to bleed a little bit now, but be able to be okay later? Or do you just want to take your lump hit right now and just get it over with. Rip the Band-Aid off. Those are the two
Right.
options you're said. That was much better said by someone much more senior in this real estate business than I am. Well, Ryan, I think that we have covered plenty to be able to give to our new listeners. How would someone get in contact with you if they wanted to?
Yeah, best way to reach out to me, and I'll give you my email, ryankelly@kw.com. You can go to Ryan Kelly Group on Facebook and YouTube. I have a YouTube channel. And so if you want to reach me there and see some of the content, check that out. And in other words, happy to. And of course, you can always reach out to Thomas too, and he'll put you in touch with me as well.
Absolutely. Thank you again, Ryan, for your time, and wish you well on this new property you're about to close.
Appreciate it. Talk to you soon.
Cheers.